5 years certain. The certain that I'm using is the same certain that you know. Me certain say. This is a, you know what I mean? Certain. So when it's a 5 years certain, that's what you're talking about. So if you die after 1 month, 59 months is paid to your beneficiary. If you die after 10 years, that's it. Because it's a 5 years certain and based on you being alive thereafter. So every time they're going to pay after that, they say, are you alive? So if you're not alive, that's it. If you're alive, they pay. Now you could have 5 years certain, you could have 0 years certain, you could have 10 years certain. It's up to you. That is what you call a traditional annuity. And the amount you get never changes. It is the same. So if you live from 65 to 100 and you started off at 100,000 a month, when you're 99, you're getting the same 100,000 a month. Unless, of course, you bought an indexed annuity, which is not traditional. And that's the point. It is not. Now, oh, by the way, when you retire, you have the right under Mrs. Hennessy's law to make you can choose what option you want. No matter what is in the scheme, when you reach retirement, under the law, so long as that option is defined under the law, you have a right to choose it. Now, I would say that the Jamaican marketplace has not been very innovative and creative in the areas of those products. Maybe it's going to change because you have new people coming in, right? You have new people coming in, people who are non-life insurance and non-this and non-that. They're financial institutions. They might be a little bit more creative and innovative. I myself predicate my life on being creative and innovative. See, when you're an ugly young man growing up, if you're not creative and innovative, you lose out on many things. So you have to be creative and innovative. So that's how I crafted my life. Now, so that's the traditional, and that's one of two of the main problems in traditional annuity. Two of the main problems. One, the amount never increases. Two, once you buy it, your money is locked away forever. In other words, that's it. So if you buy it for 5 years, certain life thereafter, if you get one payment, yes, the other 59 will be paid. But that's the end of it. It doesn't matter how much money you paid in. That is out of the question because you swap it. You swap your money for that series of benefits. So it's gone. All right? The other one is with the traditional annuity, the payment never increases. Now, those are two of the main problems that people have with traditional annuities. But the question could be posed, are there non-traditional annuities? And yes, there are non-traditional annuities. As I said, we will have to look at this in the Jamaican marketplace, and I'll tell you two types which come ready to mind. Most of the plans here, especially ARS, they are what you call unitized plans. They operate like mutual funds. And even so, every insurance company in Jamaica has unitized funds. And instead of saying that what they are guaranteeing you is a monetary amount, what they could guarantee you is the unit amount. In other words, let us say you have a lump sum of $10 million when you retire. Listen carefully. I'm fairly good at this. You have a lump sum of $10 million. That $10 million must buy your pension. But it is invested in a fund where the unit value is $1. So it means that that $10 million can buy 10 million units on that day. Because the unit price is only $1. Now suppose the actuary says, well, if you take this $10 million, it can buy you $1 million a year in your pension. Forget about the month for the time being. 1 million a year. Well, that 1 million a year is no different from saying you divide the 1 million by the unit price is 1 million units. So what they now promise you is not the $1 million, but the million units. But the units are invested. And they keep on going up or down, but if you invest in the right kind of fund with a lot of fixed income and all that, chances are it always go up. So what you end up now is with an increasing annuity. And if you do a proper mix of funds, a proper mix of assets in the funds, then you might have a little equity there too and a little property which helps the units to go up with inflation. You get the point? So when we talk about information and education about pensions, it involves a lot, every aspect of pension, right? Including investments. Okay, that's one type. The other type, which is also very good, which incorporates this type too, but it's a bit different. And Mrs. Hennes will have to approve this, but she and I have had good arguments over this. We quarreled sometime, but I tell you, me and them move good. No argument about it. That don't mean no quarrel later, but very good friends. I like this one. I call it a certain name. Some people don't like the name, but I like it. I will call it by name, I will describe it, and you can talk to anybody, because it's the description that counts, not the name. I like to call it a payout annuity. What do I mean by that? They go back to the same 10 million. The 10 million will remain yours until you reach age 80. The actuary determines how many of those units you must get between your retirement age and age 80. Right? So you're getting the units every month, but it's being deducted from your own account. And then when you reach age 80, whatever remains in your name must now be used to buy an annuity. But by the time you reach 80, you're much closer to, you know what I mean, that big day, right? So you're not so, and you're much better position then to get a much better value for the traditional annuity. I did one this week. I did the calculations and as demonstration. And based on what I assumed, and I was very conservative, if that person lived to age 80, the person would end up buying a traditional annuity that gives him 5 times the amount that he would get if he had bought the annuity at age 65. In other words, when you reach 80 and say, okay, sell me the annuity now. If at 65 he was going to get 20,000 a month, he would get 100,000 a month from 80 until he died. So these are some of the issues. And of course, if Scotia is interested in exploring these matters, of course, they know who to call, right? So basically, but it's very important, and I think I must commend Diane, because she insisted that this be the last part of my presentation, right? She utterly insisted that it is so important, and she wants to explore that and for people to understand that it can be different. And it's just that, look, lack of competition is always a bad thing. And I think annuities have always been controlled by insurance companies and pension funds. And they do what they do, and they make their money or they make their money. I have no problem with that. Every institution does it. Banks charge fees, right? They do products where not so transparent. But these are some of the things that you can look at when it comes to annuity. It is very important, and never forget though, you know, once you retire, it is your right. And if they don't give you that right, you write to Miss Hennes, and she will give you back your right. It is your right to choose, so long as it's approved by the FSC. Said this can be done. It is your right to choose which one. Well, I know I've gone on too long, but believe you me, with my passion for pension, I would say I've even started, but I know you have to leave. So I'm going to stop, and I will take any questions you have. But again, before I leave, congratulations to everybody on your beautiful presentations, and of course to Scotia for hosting this. I love you. Talk to you.